So chapter 10 brings us into the beginning of our insurance chapter. So we have kind of three insurance chapters, life insurance, health insurance, and the first one here is about property and vehicle insurance. Now, I know probably most of you haven't dealt with really property insurance too much, if at all. You might have had some dealings with car insurance or motor vehicle insurance. I don't know where you say auto car insurance. Or maybe your parents have already paid for it. And some of you may just be thinking, oh, this is all I know about car insurance.
We love the new apartment.
The natural light is amazing.
Hardwood floors.
There is a bit of a clogging problem.
At least Geico makes it easy to bundle our renters and car insurance.
Yeah, helping us save even more.
For bundling made easy, go.
Anyway, that's of course a Geico commercial, and you probably get annoyed. You have Geico, Progressive, whatever, all the major insurance companies, and they're on the TV all the time. So anyway, we'll talk about car insurance here, this chapter. So there's your learning objectives. So what is insurance? Very important, especially when it comes to financial planning. You want to protect yourself against risk of loss. Okay, so insurance is protection against possible financial loss, and it gives you peace of mind. It's nice knowing when you're sleeping in your house that if something were to happen, you're protected. If you get in a car accident, you're not going to lose your car, and so on. And to be able to have this insurance, you pay what's called a premium. Okay, this is the fee that it's like your bill basically. Okay, that is your premium. So certain types of risk, you have there's a risk which is uncertainty or lack of predictability of a loss or something like that. So some technical terms here you're probably not familiar with. Peril. Peril is the cause of a possible loss. So it could be fire, wind, explosion, pretty rare, robbery, and so on. A hazard increases the likelihood of a loss, such as defective house wiring. So pure risk, most common types of risk are personal property, liability risk. Just trying to think if there's anything else I really wanted to say there. Speculative risk would be like gambling and so on. You can't really insure against that per se. So some of the risk management methods, so that's what insurance is all about, is how do we manage our risk. And risk management is an organized strategy. So risk management is how we protect ourselves. And so you see here we got 4 different kind of terminologies or different ways of looking at risk. And you definitely will have some of this on the quiz. So we have risk avoidance, I mean we just don't do it. We don't get in the car and go. Risk reduction. So for example, we wear a seatbelt, we install a smoke alarm, and so on, so we're reducing our risk. Risk assumption means that I'm going to assume all of the risks, so I have self-insurance. So I don't even buy any insurance, and there are companies that will collect money from their employees and have that pool of money be used to pay, say, the health bills or the doctor bills or whatever for kind of the health insurance. That would be self-insurance or risk assumption. And risk shifting says, okay, I'm going to take the risk of me driving my car and wrecking it, and I'm going to shift that risk over to an insurance company. So for them to take on the risk, they have to charge me a premium. So that's why I buy the insurance, because I'm shifting the risk. So that's really what, for the most part, we're talking about when we talk about insurance. So property and liability insurance. Property, you should already know, that's anything basically that you own. And as I've said before, I believe a lot of floods are not included in homeowner insurance. Liability insurance in case someone gets hurt on your property or something like that. So potential property losses, as I just mentioned, assets, there you go. And you're not going to insure your clothes, but you can have homeowners property that will help pay for a lot of that stuff. So the risk is, of course, physical damage caused by hazards such as fire, wind, and smoke. Okay, so I want to make sure you understand the difference between, once again, the kind of the peril and the hazard here. So, because I don't think they use the best example there. So, let's say you're sitting inside your house and you're smoking a cigarette. Okay? You're smoking a cigarette. That is the hazard. Okay? When your house catches on fire, that is the peril. Okay? So the hazard is the thing that can make it more likely that the fire happens, and the peril is the fire. Okay, so I don't like the fact that I even kind of, that's why I highlighted that. So it really should be kind of like peril. But so what are the things that increase the chance of something bad happening? Okay, would be hazard. Okay, so they have risk, loss of use. Here's just a quick video kind of about property insurance, liability insurance. So anyway, that was the liability insurance. Here's another situation where this was after the surgery was completed. They found out he had a pain in his body, and it's because they left a surgical instrument inside of that person. And here's another example. So maybe in case you're ever in a major surgery, maybe put a post-it note on your head. Don't leave any instruments in there. Okay, so that's what we call liability protection. Let me just read it here. Liability is legal responsibility for financial costs of another person's losses or injury. So those doctors have very expensive liability protection in case they do something like what I just showed you. Because it can happen. Negligence means, I just showed you a great example of negligence. You left your tools inside somebody's body. Okay? So failure to take ordinary reasonable care, which is what they did. And therefore someone's going to sue you, so you'd want to have liability insurance about that. Okay? So homeowners insurance includes damage to also your garage, your tool shed, even can be your trees and shrubs and plants, believe it or not, and can provide additional living expenses if you have to move out of your home. Personal property home or wild tribe, you can have floaters. So for example, my wife has some jewelry, and we have a personal property floater we have on top of our regular homeowners insurance. She has insured like her ring or whatever that was from her mom. I think it's only worth a few $1,000s, but she still has insurance on it. Household inventory, and you should have documentation if you're going to do anything like that. You can also get what's called medical payments coverage. This is, once again, regarding your home, and it'll help against like accidental injuries on your property. But most homeowners policies can provide a basic liability coverage of about $100,000. So some people will have what we call an umbrella policy, so good term to know. Also called a kind of personal catastrophe policy, and it supplements your liability coverage. So you can get like $1 million or more in liability coverage in case someone has an accident on your property. So this is a big thing, and I mentioned this a few minutes ago. Homeowners insurance usually does not cover losses from floods. You might want to underline that. So I want to show you this picture here. Hurricane Harvey went to Texas a few years ago, and as you can see, numerous houses were under feet of, 3 feet, 4 feet, even 8 feet of water where they had never had any flooding before this. And these people did not have any flood insurance. They all had homeowners insurance, but they did not have any flood insurance. So the point is, earthquake, which most people aren't really worried about unless you live in California and you have zones where you have to have an earthquake insurance. And there are zones, the United States has a map of where it's most like you have a 100-year floodplain. And if you live in that floodplain, you are required to get flood insurance, which is in addition to your homeowner's insurance. And you get that through the National Flood Insurance Program. So when we get something extra like earthquake insurance, that's what we call an endorsement. It's in addition to the coverage of the homeowner's policy. Okay? Endorsements, it's kind of like a rider. We also call it a rider. Also call it like a floater, things like that. You can read that anti-concurrent causation clause. It just means that your insurer can reject one of the claims if there's multiple things that are causing an issue. Probably the most relevant insurance that I'm going to talk about in this chapter is renter's insurance, because most of you will be renting an apartment after you graduate, or a home or something. This is to protect all of your belongings in the apartment, not necessarily the apartment, because that's what your landlord should have, but it's your personal belongings. And if you look at them, you got your couch, your bed, and other furniture, and your laptop or whatever, and it's probably not going to come to that much money. But if there was a fire and it burned it all up, you would be out. So something to think about is renter's insurance. It's not that expensive because it's not that much that your stuff is worth. It just depends on how much your stuff is worth. And only about 40%, 4 out of 10 renters have insurance. So I'm not going to say one way or another whether you should have it or whatever. So the book's authors suggest that when you're buying home insurance, you look for a policy with full coverage rather than co-insurance. So co-insurance means if your house burns down, you would have to pay for part of it. You insure it kind of together, if you will. You'd only pay for part of the loss. So two kind of ways to look at insurance, especially for homeowners insurance, and you can get for other things. So you have what's called actual cash value, which means that if you have a loss of that item, the payment you get is the current replacement cost less depreciation. So if you think about it, let's say you bought a computer and it's worth $500, and 3 years later someone steals it. Actual cash value means, okay, it was $500, that's what you paid for it, but they're going to depreciate it at whatever rate. It might only be worth $300. Whereas replacement value says you would be able to buy a brand new computer, comparable to what you had, and whatever that price was, that's what you would get. That's what we call replacement value. You receive the call to repair or replace it. And this is going to cost a little bit more than the other one because simply you're getting more for your money. So how much coverage do you need? Well, it depends on what you think your house is worth. If you had to replace your home, what would it be worth? How much stuff do you have inside of it? Do you want to have liability in case someone gets hurt on your property? Do you want to include all of these other things that you might have in your house? So all of those are factors in terms of how do you decide how much insurance you have. So some of the factors that determine how much you have to pay for your home insurance is like, where is it located? Of course, if it's in a floodplain, if it's and you're in the woods where there's been fires, if it's on the coast where there might be earthquakes, might be one thing. It's close to a highway maybe. The type of structure, so brick houses usually cost less because they're not as likely to burn up. They're more structurally sound. Tornadoes are not going to impact them as much. The biggest thing that impacts all of your insurance costs, regardless if it's health, life, not life, but car or house, is the deductible. Now I've got a slide on this a little bit later, but deductibles are simply the amount that you are responsible for. So for example, let's say you have car insurance and you have a deductible of $1,000 and your car has an accident and it costs $5,000 to fix. You have to pay the first $1,000 out of the $5,000 before it even goes to the insurance company. So if your accident was only $500, then you wouldn't even report it, shouldn't even really report it to the insurance company because they're not going to give you any money anyway. So this number could be like as low as $100 or about as high as $1,000 for a car typically. And so the more that you have in deductibles, the larger that amount, the lower your premiums, because insurance company doesn't have to pay as much. As simple as that. And that's probably the kind of the biggest advice that financial planners would say is, hey, let's just raise the deductible because chances of you getting in an accident probably are not that high, and if you do, you can probably afford $1,000 and then you don't have to worry about your insurance rates going up and so on. So most common deductibles are kind of $500 to $1,000. You can get some discounts. So for example, I have my cars and my home all in one from one insurance company, and you get a discount because of that. The more cars you have on there, I have 2 cars, you get a little bit of a discount. If you have an alarm system and smoke detectors, all that kind of stuff, they'll ask you all these questions and you can get some discounts. Here's Consumer Reports. They mention again, you can get kind of customer satisfactions indexes from what their experience has been with their insurance company. So nearly all states, I think it's like 48, have compulsory auto insurance laws, which means you have to have car insurance if you're driving. So automobile insurance falls into 2 categories, what we call bodily injury and property damage. So as you can imagine, one deals with when you get injured in the car and one deals with the car itself. So this is something you're going to have to know for the quiz, or you can print this out. So on your notes there, I just kind of put these numbers, so you have to make a note on your notes kind of what these refer to, or either print this out or something. So this is how you typically see on, if you looked at your car insurance policy, it would have like these 3 numbers. And so the first one represents how much would be paid to one person in an accident, okay? So this is the bodily injury part. The next one represents the total to be paid to all persons. So you might have had 5 people in the car, but a total of only $300,000 can be paid out. And then this is for the car itself, or damage to property of others. Okay. So anyway. So the bodily injury covers the risk of financial loss due to legal expenses, medical expenses, lost wages. So it can be a lot of things, not just the hospital bills. And so these are costs that you were responsible for. So you were in the accident, you caused the accident. Medical payments coverage covers the cost of health insurance for the persons injured in your automobile, including yourself. Okay, so that's what we call medical payments, bodily injury. Uninsured motorists, because even though by law you have to have insurance, not everybody does. Covers the cost of injuries to you and your family if your vehicle is hit by another person. However, it does not cover property damage. Okay, so that's important to remember that at least this particular item doesn't cover the car. You have other coverage that does, but this one is really about the injuries sustained by the people. So then we have, this is just a lot of terminology. Property damage covers damage to other people's cars. So if you run into somebody else's car, this help pays to get their car fixed. Collision pays for the damage to your automobile, regardless of who is at fault. Okay. Sometimes just an accident by two people. You don't even know who's necessarily at fault. Okay? So that's kind of the difference between those two. If you are not at fault, your insurer will try to collect from the other driver's, insurance first. So coverage is limited to the actual cash value of your vehicle. So your vehicle might be in really great shape or really bad shape. That doesn't really matter because the insurance company didn't look at your car right before the accident. So they're going to look at what they call the NADA, the National Association of Dealers Association. They're kind of like, here's what a normal 2000 Chevy whatever is worth, and then that's what they'll base on, how much it costs to get fixed, or if it's totaled or something like that, meaning you don't get anything back for it. Comprehensive physical damage covers damage to your vehicle that is not caused by a collision. So if a tree falls on it, you have wind, hail, flood, falling objects, a lot of different things could cause it. It has nothing to do with a collision. Okay? So I mentioned deductible earlier, and this is the slide that talks about deductible. So if a broken windshield costs $250 and you have a $100 deductible, then you'd have to pay $150. So there are other things that you can add on to your insurance. Wage loss in case you get into an accident and you can't go to work. You can get towing and emergency road service. Doesn't cost that much. So these are the amounts that the authors recommend, which is kind of the most typical insurance to get. Remember those three numbers you had across there. And you can also get $1 million umbrella liability. It's also recommended because I know that sounds like a huge amount, but it usually doesn't cost that much. So if you have anything that's worth like $50,000 to $100,000, it's usually suggested you get property damage liability. So factors that impact the price of your car insurance are, how old it is, what kind of model it is, and also some cars are more prone to be stolen than others. Also, depending on what state you're in or what area you're in. Okay, so if you click on that link in the PowerPoint, if you bring it up, it's just some kind of interesting here. The most and least expensive vehicles to insure. Here's the cheapest cars to insure: the Mazda, Honda Wrangler, Subaru Fiat, and the most. So there's kind of a top 10 list, cheapest cars. You can actually go down to top 20. Okay? Top 5 most expensive. As you can see, they're a little bit more expensive cars. And there's the list also there. A little bit more there. You can see, more expensive cars are going to cost you more, and so on. And of course, age, sex, marital status, credit history. We'll talk all about that here in a minute. All those have big impacts on how much your insurance is. So some ways to reduce your prices. I'm going to show you prices here in a minute. You can compare them online. There's a few different insurance places. But here's the biggest thing to remember. Do your best to drive safe, not get tickets, especially driving while under influence. So avoid accidents and traffic violations. Even if you're in an accident and it's not your fault, that's going to hurt your insurance cost in the future. So, as I mentioned earlier, increase your deductibles. That'll help lower your cost. And so, before we leave here, I want to show you a few statistics. So here are the cheapest car insurance companies in Ohio. And you can see Geico is the winner by a little bit over USSA and Erie. Now, that doesn't mean that for every single car and every single customer, it will always be Geico. Okay, that could change. So the point here is, don't just go with maybe your parents' insurance agent. Do some checking around. Make a few phone calls and say, here's my situation. What kind of rate can you give me? Because that adds up. That's per month there. Okay? Here's cheapest car insurance companies, and I know it has the Geico again. So one reason why you see a lot of Geico ads, and they do have a lot of very good rates. And here's the average premium for cars. And you can see once again it changes quite a bit. Now I mentioned one of the things that can impact your credit scores is, your insurance rates are your credit scores. And so you can see here, farmers insurance actually allows you to save a lot more if you have a really good credit score. So you can reduce your rates by up to 54%. Geico, you can only save 20% based on your credit score, but you could also argue that they have a lower starting point anyway. So people with no credit pay 67% more for car insurance than people with excellent credit on average. And so the states that are lighter means it's the more premium you have to pay if you don't have any credit. So this was an interesting study that Consumer Reports says, what makes your car insurance go up or down? So premium increase. Having poor credit can increase your insurance rates more than having DWIs, driving while under the influence, or having even accidents, or adding a teenager. Right? So having a good credit score is so important for many different reasons. So we talked about renter's insurance earlier. I just wanted to show you some statistics on kind of what renter's insurance on average cost. So here you can see the annual premium in Ohio is about $185. So this, that's not so bad. And about 34% of those in Ohio have renter's insurance. Remember, I told you it was like 4 out of 10 on a national basis. Okay, so that's it for chapter 10.